Um, Good morning, and when people are coming in, I'm just helping some people get in. But Simbarashe from Algeria came in yesterday. I just wanted to say people came in from different parts of the world, and you're very welcomed here. And if you rename yourself and you put your location, it just shows us we're creating a fabric that's extending more and more worldwide. And that's great. You had Philip yesterday from Ghana, Connie from Netherlands, and many more people. And so we can work on starting a new movement. And thank you all for being here. It says Dr. Leah Downing is an emerging scholar in political theory, focusing on how democracy intersects with economic governance, particularly monetary policy, with academic roots spanning the US and UK, and a growing portfolio of influential publications, including an upcoming book. I think this is it. This might be old. I'm sorry about that. She is making a significant impact in discussions about democratic accountability. I would like to ask Leah um, in reading your book, were you something of a philosophy major, a political science major, a political science theorist, historian? And can you just describe a bit of your background, please? Because I would like to know a little bit more. And then I'm going
Yeah.
to go on and continue introducing you, but I
Oh,
want to lay
okay,
a good
okay.
foundation so we understand you well.
Yeah, it's not obvious, and that's because it's a slightly unconventional history. I have my primary undergraduate degree is in mathematics. And then I added a second major in economics because I wanted something slightly closer to human activity. And I was pretty disenchanted early on with the way economics was taught and sort of what you were allowed to talk about and in the ways you were allowed to talk about it. And at my last year at UNC, where I did my undergraduate degree, I had a reading course with a professor, and we just read Schumpeter's Capitalism, Socialism, and Democracy through together. And I was sort of like, this is the kind of stuff I want to talk about. I don't necessarily agree with him totally, but this is fun. This is what it's about. And so I went on to do a master's degree at LSE, a joint master's in economics and philosophy. And then I've done my PhD in political theory. So the answer to your question is a little bit of everything, kind of.
Right, right. My background, I felt that way that we were connected a little bit. I had a political science degree, but it was basically a liberal arts degree, and I would be moving around and but anyhow, enough of that. So I'm going to read this part about the talk, but then I'm going to add a few bits and relative to this conference too. But in this presentation, Dr. Leah Downing will challenge the conventional wisdom that central banks must remain insulated from political influence. I'm going to read slower because this is important. Instead, she argues for restoring democratic accountability over monetary policy, balancing power back to the legislature and ensuring that money creation reflects the broader public good. Notice you got in legislature and the broader public good. drawing, drawing on deep political theory and institutional analysis, she introduces the concept of iterative uh, governance. If I'm finding the word, I've just lost my place. No, iterative monetary policy, a framework in which elected representatives continuously monitor, review, and guide central bank decision making. By treating the Fed as an agent under democratic oversight rather than a technical black box, Downey shows how financial governance can be both informed by expertise and shaped by the public will, making monetary policy more responsive, transparent, and just. So that's a tall order. It's and it's going to be a tall order for us to carrying it out. So without further ado, Leah, can you give us our marching orders now?
I can try. I can try. So let me share my screen. Let me first just say a huge thank you to Stephen for inviting me to be here today. It's really exciting to get to talk to you all. And I'm sad that I haven't been able to see all of the presentations. It's a really fantastic lineup that you guys have. So, Stephen's asked me to talk a bit about the book. When I started writing this book, central banks, monetary policy, as I'm sure all of you have experienced, aren't generally thought of as the sort of coolest subject in town, right? They're not usually huge news, and they're certainly not usually paid attention to by political theorists and people interested in democratic theory. But that has, in recent sort of weeks and months, changed given what's going on in the US. So I thought what I would do with the Federal Reserve and Trump. So I thought what I would do today is instead of just giving you an overview of the book, I would center in a little bit on central bank independence and review and challenge some of the main arguments for it that are generally considered sort of conventional wisdom. And then also at the end, briefly talk about, which is really the core of the book, arguments against it, right, from a democratic perspective, and give you a bit of a preview of what I suggest is a better alternative. Just to give you, though, before we get into the nitty-gritty of all that, a sense of what I do in the book, the idea is really to take seriously what I see as a foundational connection between monetary policy and democracy. And as I see it, the key is really in the subtitle, right? So I ask what monetary policy as if democracy matters would look like. And to that effect,
Leah, I just want to mention one idea, just to give you a base. I wanted to write this. Gretchen Morgenson, a financial investigator, went as far yesterday as to say we live in a failed monetary system, a failed money and banking system. So I just wanted you to know how deep the hole is.
great,
And okay, thank you.
great.
Please continue. I just wanted to
Yeah.
get that clear.
Yeah, no, great. I think, most of the presentation today is going to be in supporting that argument, essentially, that saying the governance system, the way that we have approached governing money in the US and most countries around the world, has been a causal factor in that problem, I suppose you could argue.
Yeah.
But yeah, so I've split the book just to give you a view of what is in there, if you're interested, into sort of three sections. The first talks about monetary policy and focuses particularly on the US. But as I just mentioned, I mean, given the wide adoption of central bank independence and the theories behind it, the story can definitely travel. The second part of the book is more political theory, and it's here that I essentially argue that an independent central bank could be democratically legitimate and accountable, and yet still a threat to the democracy over time. And that's the key argument, really. And I suggest an alternative, as Stephen mentioned, which is this approach of iterative governance, which I'll come back to at the end of the talk. And then the last part of the book, which I won't get into in the talk much today, but I'd be happy to discuss after, is sort of how does this whole picture fit into a global financial economy? Okay, so let's just start, if we're looking at central bank independence, with a few motivating facts from the past few months in the US. As I'm sure many of you already know this, uh, President Trump has been attempting to wrest control of the Federal Reserve. He pushed out the vice chair of supervision, Michael Barr, before he was even inaugurated. We then had a quick resignation of Governor Kugler in August. We've had ongoing threats from Trump to fire Powell and discussions of developing a fraud case around the Fed's renovation project. And we now have the attempted firing of Lisa Cook, a governor on the Board of Governors, again, claiming that this firing could be for cause with accusations of mortgage fraud. Now, that is a move that has now been challenged in the courts, and at least two courts have upheld Lisa Cook's challenge to that. But what is, regardless of the legal ins and outs of the case, what's very clear is that what Trump has done is against the norms and practices of central bank independence that have developed over the last few decades. So, what exactly is going on here? Well, the first thing I think we have to say is that what Trump is doing is absolutely not democratic, right? Despite what his vice president has argued, right? So on August 28th, JD Vance gave an interview where he said the following. It's a long quote, but I think it's worth reading. I thought the people controlled this country. The people made the determinations in this country through their elected representatives, including the President of the United States. I think that's fundamentally what this is about. Who makes the decisions in this country? Is it those that people elect, or is it the unelected bureaucrats? I feel strongly that the President of the United States is much better able to make these determinations. You can't say that democratic decision making has no influence over monetary policy. That's really, really, I think, an anti-democratic principle. So I think the first thing to say about this quote that's quite interesting is that Vance is saying outright that the issue here is not Lisa Cook. It's not mortgage fraud. So the legal basis of President Trump's case for firing her, according to Vance, is obviously a pretense, and the vice president admits that. But then the more important thing to say is to ask sort of what should we make of these claims about democracy? And what is glaringly obvious to anyone who studies democratic theory, and most others, I think, is that democracy is not about just giving more power to any given elected official. Centralizing power in one particular individual is, in fact, at odds with many centuries of democratic theory, let alone centralizing the power to create and allocate money. This, of course, was exactly the power, centralizing this power is what motivated the English Civil War. There, centralized power over money was too much, even for a king, let alone a president. So this simple fact has been clear to political theorists and practitioners for a very long time. In fact, it was exactly why the writers of the US Constitution gave the power over monetary policy explicitly to the legislature, not the president. And so I think it's important to recognize this up front, and I'm sure many of you would agree with this, but it's worth stating it forcefully that Trump's attempts to take power over the Fed, especially through securing a majority of the Board of Governors in pursuit of presidential power over monetary policy, just simply can't be defended on democratic terms. Now, as I say, perhaps this isn't news, especially to this audience, but here is where I think many commentators about this issue have gone wrong. So they see that Trump's move is not democratic, and consequently they reject it and go on to defend the status quo. But the enemy of my enemy is not always my friend, right? So Vance is completely wrong in his suggestion that Trump should have singular control over the Federal Reserve. But in my view, he's not wrong about the contemporary structure of the Fed being, at the very least, odd and at most clearly undemocratic. I'm happy to come back to the odd details of the contemporary Fed structure, but I'll leave that there for now. In essence, what's bothered me most about the commentary recently is that in response to Trump's blatant attempts to wrest power over the central bank, we've seen op-ed after op-ed by experts about the essential importance of central bank independence and how crucial it is to a successful democracy. And this is what I simply don't agree with. So I want to strongly emphasize today that one doesn't have to be committed to central bank independence in order to object to Trump's actions. And in fact, what I'm going to suggest is that a commitment to a healthy democracy would require that we reject both, right? We reject both Trump's actions and the arguments behind central bank independence. So what I'm going to do is, in light of the recent hubbub, is lay out for you an overview of the arguments, the sort of most common arguments we see both for and against central bank independence. And then I'll give you a really cursory outline at the end of what I think would be a better approach. So, traditionally, you'll hear arguments for central bank independence, usually without mention very much of those arguments against it. And most commonly, these arguments are not really deeply interrogated or pushed or prodded, especially in sort of popular publications. They tend to take the form of, trust me, it's a good thing, right? So recently, Jason Furman published an op-ed in the New York Times that included the sentence, independence is vital for central banks. People from governments to banks need to have confidence the Fed is making its own decisions. Otherwise, bad outcomes can easily follow. But when we look harder at this, things are clearly not that straightforward. So there are essentially two types of arguments in favor of central bank independence. There are empirical arguments and there are theoretical arguments. We'll start here with empirical arguments. The empirical defenses of central bank independence tend to rest on a few studies that are cited over and over again. And I'm just going to mention two of the most popular here today. One of them is a paper written by Alberto Alesina and Larry Summers that was published in 1993, where they claim to have discovered a near perfect correlation between central bank independence and inflation. The study spanned the time period of 1955 to 1988, and it included 16 countries, all of which were OECD countries. Even the authors themselves were a bit cautious in their claims at the end, in their conclusion, where they said that the results here should not be considered conclusive, right? In the sense that we've looked at the data only in a very straightforward way. More detailed analysis of the relationship between central bank independence and real performance is warranted. And in particular, they point out the difficulty of measuring central bank independence and also the possibility of endogeneity, which I'll mention again in a few minutes. Basically, what happens in this paper is the authors found a simple correlation between two variables over a particular period of time across quite a restricted set of observations. And while it's definitely interesting, as they admit, it's hardly conclusive, particularly when you're considering a causal connection, right? Does central bank independence lead to lower inflation? The second paper that's often cited was one written by Crow and Mead and published quite a bit later in 2008. And interestingly, this paper starts with a discussion of how, despite the theoretical acceptance and wide adoption of central bank independence across states since the 1980s, they write, quote, empirical studies have found surprisingly limited evidence of independence delivering its promised anti-inflation benefits in practice. They specifically reference the Alesina and Summers paper that I just mentioned before pointing out that a large set of later studies that span a wider data set produce equivocal results. So they do conclude, they argue that their evidence suggests that there is robust evidence for a relationship between central bank independence and lower inflation, but only after first achieving results that confirm the puzzlingly weak and non-existent relationship between CBI and inflation found in the literature. Then they apply quite an elaborate set of econometric adjustments. So they seek to distinguish between de facto and de jure independence. They also go on to apply instrumental variables for things like governance measures of the rule of law, voice, and accountability. And they claim this is justified because they believe that institutions such as a strong legal system and an independent civil service will influence inflation only through central bank independence, which seems highly implausible to me. Anyway, I won't go into the econometric details here, and I won't bore you, except to point out all I'm trying to highlight here with these two commonly cited examples is that the empirical evidence that's marshaled in favor of central bank independence is hardly straightforward, and at times can read like researchers in search of a particular result. And this is all not even to mention the other complicating factors, which is the difficulty of measuring central bank independence, very famously difficult, and also the possibility of reverse causation and the idea that central bank independence is actually should be best understood as a signaling effect. To this sort of point, one leading alternative theory is that central bank independence actually emerges as a consequence or a signal of a governance regime that has policies which are more likely to achieve low and stable inflation, but is not actually a cause of it. Okay, moving on quickly to the theoretical defenses of central bank independence, and these are the ones that probably you might be most familiar with. The first, I'm going to address three here quickly. The first is the suggestion that monetary policy is simply too complex for democratic influence, right? So politicians and voters just can't understand it, and that's why we need insulated central bankers. This argument, in my view, is just kind of silly. I mean, first, is monetary policy, should we think that it's actually so much more complex than, say, fiscal policy or nuclear policy or environmental policy? It's not clear to me that it is. And second, and I think most importantly, is that complexity gives us a reason to engage expertise, right? But it doesn't give us a reason to give experts autonomy or independence over the matter. right? So it's important to remember that to argue against central bank independence is not an argument to eliminate the Fed and ask Congress to create monetary policy on its own. Rather, it's an argument for Congress to exercise effective, active guiding power over the Fed, regularly engaging in steering the policymaking process. So I think the complexity argument is not a very strong one. Furthermore, those that make it, if they follow their logic, and Alan Blinder made this argument in the early 90s, it leads you to argue that most other areas of policy should also be insulated from democratic politics as well, right? So we should be pulling more things out of democratic discussion, not fewer, which I find implausible. Okay, the second and most foundational idea that defends central bank independence is the concept of time and consistency. This is the basic idea that what looks like good policy in the short run doesn't actually match up with what is good policy in the long run. So, more specifically, defenders of central bank independence claim that monetary policy is time inconsistent because of the electoral business cycle, right? So, politicians will want to juice the economy in the lead up to an election, and this will cause damaging inflation in the long run. There's lots to say about this argument and this model, but I'm just going to make one or two points here. The first is that, as in the case of complexity, it's not clear to me that monetary policy is unique in this way, right? So politicians might want to juice the economy using, say, low interest rates right before an election, but they also want to lower taxes or spend loads of money or end or start wars or do all kinds of things in the lead up to an election to appeal to the electorate. Not all of which are good ideas in the long term. And yet we still think that Democratic politicians should still control these policy areas for democratic reasons. So it's still not convincing to me yet that monetary policy is meaningfully different in this temporal dimension from the other areas of policy where we insist that democratic leaders play a vital role. Furthermore, to suggest that voters and politicians are incapable of recognizing this point, right? The longer term effects of short term policy seems far fetched to me. It's, of course, true that voters and politicians can have a short term bias, right? But this hardly prevents them from discussing and considering longer term consequences of policy, right? Tax policy is an obvious example here, right? If one party proposes to cut taxes, the other party often says, well, there are poor long term consequences for that. And it certainly doesn't seem like reason enough to me, this short term bias, to insulate such a fundamental state power from democratic control, especially when there's no ironclad connection, theoretically, in economic theory, between short term monetary policy adjustments and long term dangerous inflation. As most central bankers will tell you, we don't have a good working theory of inflation today. Okay, perhaps most significantly is the theoretical argument behind the proposed solution to time inconsistency, and this is credible commitment. The idea is that since most politicians can't be trusted, the legislature should tie itself to the mast, like Ulysses did, to ensure good monetary policy. The mast here being central bank independence. So, setting aside whether it is in fact the case that insulated central bankers can deliver good monetary policy, however you want to define that, I'm going to suggest that the Ulysses analogy here is simply not appropriate, right? And focus on one reason that that's the case. Ulysses is tied to the mast, right? So that he can hear the music of the sirens, but can't actually do anything in terms of steering the boat to keep the boat on good course. So he can't do anything except hear. He can't steer, he can't row or navigate or cook or clean or anything else that you might need to do on the ship. The legislature, by contrast, has a lot to do, right? Even if it chooses not to engage in monetary policy, including pass policies that might influence monetary policy or could be served by the use of monetary policy. So, this, in my view, is an essential disanalogy here because it demonstrates that in the case of central bank independence, the trade off is not so simple as it is in the case of Ulysses. And I'll come back to this in a minute. So, I want to just, with that quite quick run through of the arguments for central bank independence, simply suggest that the empirical and theoretical evidence in favor is far from conclusive, and in the case of the empirics, and a bit shaky, in my view, theoretically. It fails to distinguish monetary policy successfully from other policy areas, fails to define what good policy is, or offer an argument for why insulated experts should be capable of delivering it. And it offers overly simplistic claims about why politicians are unlikely to make good choices. Finally, it fails to recognize that in embracing central bank independence, we're not just limiting legislative power over monetary policy, but we're also hamstringing the democratic body more completely. So I've just given you a bit like a very rapid fire outline of arguments in favor of central bank independence. I want to give you similarly a sense very briefly of some of the arguments against it, which are much less discussed, but they're actually much of the focus of my book. And I want to say it's important to emphasize here is whether or not you're convinced, right, that the arguments in favor of central bank independence are flat out wrong, or maybe there's just reason to think they're slightly weaker than you did before, is that's not the whole ball game, right? Because the whole ball game is weighing those arguments for central bank independence against the arguments against it, right? And I think part of what I argue in the book is that the arguments for it are weaker than you thought, and the arguments against it are really quite strong. So that's what I'm going to turn to now. So I offer two main arguments against central bank independence. One based on sort of democratic ideas, right? And here we can go back to Ulysses, right, just to get a sense of what these are, right? So I mentioned that tying Ulysses up makes it harder for him to do things, right? And this is the kind of state capacity argument, right? The legislature is incapable of doing certain things that it could do if it wasn't tied to the mast, so to speak. And then there's a democratic argument, which essentially argues that if the legislature, like Ulysses, is tied up for a long enough period of time, its capacity wanes, right? So Ulysses, it's his muscles would atrophy, his leadership capacity would weaken if he was tied to the mast for a long enough period of time. And the same, I argue, is true of the legislature, right? So let's take these in that order, right? So democracy requires that citizens are directly or indirectly via their elected officials are engaged in a system of self-rule. So they need to guide state power, particularly the key powers of the state, military and monetary. As I mentioned earlier, in the US, Congress has power over monetary policy given to it by the Constitution, and that remains true today, right? So the Congress could vote tomorrow to eliminate the Federal Reserve or to change its structure with a simple majority vote. One might suggest that shows that they're hardly truly bound to the mast, as central bank independents would say they are. But then we could ask, what's the problem, right? If Congress already has the formal power to change the Fed or to alter Fed policy, isn't it already democratic in the way that we should want? And I think that that's not true. As I argue in the book, there's a really big difference between formal and effective power. So Congress holds formal power over the Federal Reserve, but it has chosen, by appeal to central bank independence, not to exercise it regularly for decades. So this has meant that congressional power to truly engage, to steer, to rule monetary policy has atrophied. And this failure to engage means that the topic has fallen out of vigorous public debate, and the legislature isn't forced to engage with what could be different or make clear their decisions on potential reform, either structurally or operationally. In terms of state capacity, I don't want to go on for too long, but I'll just say that democracy is a system, as I've said, as a system of self-rule, and essential to that is the idea that citizens collectively have the capacity to shape their future, right? Monetary policy, as I see it, regulation of money creation. And access, of course, to credit influences the creation and recreation of the physical, social, environmental, and political world we all live in. So monetary policy is a massively important tool of democratic state power. It's currently limited in cases of central bank independence like the US to a very narrow aim and insulated from democratic politics. I've already discussed some of the threats of insulation, but I want to just mention here why it's been so narrowly targeted. And that comes down to a widely accepted theory in economic policy or in economics generally, and in central banking worlds, known as monetary neutrality or monetary policy neutrality. And this is essentially the idea that money has no effect on the real economy in the long run. So, in terms, if we're thinking about things that we can produce, right, what matters, according to this theory, is technology, capital, and labor, but not money, because money is simply what they say, simply a veil on the economy. This theory, I think, is really quite dangerous because while it allows that money has an impact in the short run, right? So it can, in the short run, impact what is produced, where it's produced, how it's produced, who is producing it. The core claim is that this impact evaporates in the long run. And as a result, monetary policy can have no real effects, and therefore it should be narrowly targeted to addressing inflation and not used as a tool to impact production. But the key issue with the theory, in my view, is that the long run that they're using in this theory is an equilibrium condition, right? So it has no relationship to calendar time at all. So it's likely the equilibrium condition is likely to never arrive, or it could arrive immediately, or it could arrive in 10 years or 100 years. We'll never know. And if there are shocks in the interim, right, a change in policy or an economic shock or a environmental shock, that equilibrium will be displaced by a different one and a different long run will be considered. So it's my view that we're likely never to reach any of these long runs, these theoretical long runs, and rather we live in a series of linked short runs. And as a consequence, money matters hugely to production. And if you say this to most people, most of my students, they say, well, obviously that's the case. But in economic theory, and it's the economic theory that underpins quite a lot of central banking work, and definitely central bank independence and this sort of narrow inflation target, the idea is that money doesn't matter. And so, thus, neither does monetary policy. The best it can do is sort of prevent disruption, as Milton Friedman put it. Now, that is, some economists are coming to challenge that view, particularly a small set at the BIS, who've argued that there is such thing as monetary policy hysteresis, but that's still quite a heterodox view. Okay, I want to finish up in the next few minutes, so and open it up to discussion. But I just want to tee up briefly, um, give you guys an idea of what I think would be a better approach to conducting monetary policy. So the Fed today, I argue, is governed according to what I call a guardrails and compliance approach, right? So the legislature determines the guardrails as set out by the Federal Reserve Act in the US. And then we ensure compliance with those guardrails, right? The legislature participates in that by holding hearings. Then you've got sometimes the judiciary, and in other cases, a third party participates in holding the central bank accountable to the existing guardrails. These things are important as they ensure that the Fed acts legitimately and is held accountable, but in my view, they're not sufficient to preserving a healthy democracy over time because they don't sustain the power of the legislature over the central bank. So these guardrails and compliance approach can ensure that the Fed is acting in accordance with existing guardrails, which is a sort what you might call a matter of backwards looking accountability, right? So asking the Fed, have what you already done line up with the existing laws? But we have no regular mechanism for the legislature to steer monetary policy going forward. As a consequence, we end up with a central bank that's democratically legitimate and properly accountable, arguably, but still a threat to democracy over time. Now, an alternative, in my view, would be to govern monetary policy not via guardrails and compliance, but iteratively. So, what does this mean? Well, this would require the legislature to know and regularly show its power over the central bank. And in the book, I suggest two mechanisms through which the Fed could do this. One would be a process of regularly rechartering the Federal Reserve System. So this would force the legislature to weigh in on the institutional structures of the Fed. Of course, the first two central banks in the US did have time limited charters. This the Fed's was only extended in 1927 in a sort of legislative sleight of hand. The second mechanism would be what I call annual credit guidance. And this would force the legislature to annually weigh in on the operations of the Fed. And I can get into the nitty gritty if you guys are interested in the Q&A, where I outline what I call the development of a preferred asset taxonomy, which the legislature would have to vote on every year. And that could be used by the Fed in a few different ways, but one potential way would be through differential asset-based reserve requirements. And this would essentially be trying to create, obviously not exactly like an annual budgetary process, because the Fed isn't subject to such a thing for the obvious reason that it can create money, but it would be analogous in the sense that it would be asking the legislature to pass judgment on the credit operations of the Federal Reserve on an annual basis. Okay, so to just briefly conclude by returning to the contemporary state of affairs in the case of the US. Trump is currently clearly trying to wrest power from the Federal Reserve. And I think it's worth noting, as I did at the start, this isn't for democratic reasons. It's also not for reasons of wartime mobilization, as it has been in the past. It's also, I think, interesting to note, it's clearly not for class-based interests, right? As the global asset holding class has benefited hugely from central bank independence since its inception. Rather, it seems to me that it's clear that is simply someone who wants money and power for himself. Again, the king analogy sort of looms here. And the Fed is the most powerful monetary printing press in the world. So he wants to control it. This is a bad thing, and we should seek to stop it. However, we should do it with a note of caution, right? Just to reiterate my point from the beginning, just because Trump's actions are wrong doesn't make central bank independence right. And central bank independence, in my view, is a threat to democracy and to state capacity to engage in the kind of truly transformative policy that I think we're in quite desperate need of at the moment. And if we fail to see this and instead we cling to the status quo ante, I fear that we'll be creating fertile ground yet again for more disruptive politics, not less. So, with that, I will leave it there and look forward, stop sharing my screen if I can, and I will look forward to the discussion. Let's see. Have I managed that? Haven't managed that, have I?
No. Uh, yeah.
Yes, you're good. We can see
Oh,
you.
okay.
Yeah.
Oh,
Yeah.
good. Okay, great.
Yeah. And I just unmuted myself too. I was slow. And so this is for the audience right now to think about. Imagine yourself in a rally and we're marching down.
Wait, no,
and,
crack that.
and we're coming together and we're rallying.
Right, that dagger.
John, I think you're
I'm sorry, I'm getting rid of it.
Thank you. So we're at a rally and we're there for monetary reform. And just to be clear, at this rally, we're putting out the law science of money, the three key points that we went over with David Korten Yamaguchi that comes from Zerlanga and then Irving Fisher in the 30s. And that is, like the Bank of England, we should have a public bank here in the United States. One. Two, why is a banking system, a private banking system, creating money when it should be some authority, public authority inside the government? So it's public creation. And three is, if that happens and the banks aren't creating new money to go into the system, into circulation, then government or some public authority, monetary authority, and Koro Yamaguchi had a number of ideas for this on Friday. So now we're at this rally and someone comes across and gives the argument for central bank independence, Fed, and everything else. We need to have a spine. Who's going to be able to stand up and then answer those questions? Who's going to be able to keep the rally going? When we go into rally mode or into campaign mode, we need to have some people who can quickly answer those questions. And in doing that right now, I think the best source we have is reading Downey's book, taking our time with it and absorbing it, and then politely speaking back good information to them in a polite way. And then we're going to move forward here. So I want to make that point as a key operational move. And also I'm mentioning it too for Leah a little bit, in that this is where we're coming from. We would like those three objectives. And but that's my take on your presentation so far. We could go globally, but let's open up because there's a whole lot of meat and we've got 5 people ready to go. And you're going to get a number one. You're going to get a lawyer to start out with. Here we go. Patrick. Wait, Patrick, you're muted.
Oh, sorry. Hold on
No,
one
you're
second.
good. You're good. You're good now. We can hear you.
Oh, sorry. Okay, thank you so much. This was such an exciting talk. I just have to just really congratulate you. You've expanded my thinking. I have not read your book. I'm excited to read your book. I'm going to read it immediately. I have 3 questions from my own experience, and I'm assuming that everything I'll mention you already have considered and you already know. But if it isn't in your book or if it's not part of your main focus, I just want to know if this goes along with the case you're making. In other words, would it enforce, enhance, supplement, be consistent with? So I basically have 3 questions, and they're based on my own reading and my own life experience. So the first question is, I read a book when it came out by Karen Petru, which I put in the chat, called Engines of Inequality. She's a Fed insider. She worked with the Fed governance at the highest level, and she did deep dive analysis on the failure of the Fed leading up to the global financial crisis and its absolute failure in its post-crisis policy. And it was an utterly damning critique because what she showed, and this is my question to you on the first point, and I'll just quickly do the second too. She made an empirical case against the Fed as it actually performs. And she showed that it had a systematic wealth bias. It increased income inequality. It increased wealth inequality. It created asset price bubbles, and it hijacked taxpayer money and the GDP of the country in the service of these goals. And so when she made her case, it was a devastating critique. And she showed that it reduced wages, it reduced levels of employment in stable jobs, and the consequence was that it was failing in its mission, which is not just inflation reduction. It's got a dual mandate, absolute abdication. So that's my first question. How do we strengthen your case by just doing empirical testing or road testing in the real world? Because your arguments frame it in a broader way. That's my first point. Second
Hey,
is,
Patrick, let's go with number 1.
well, number 2 is really important, and I'll make it one sentence. I sat
Okay.
through a hearing in the summer of '80 with Henry Gonzalez, chair of the House Banking Committee. And he had the 9 leading constitutional scholars there who made the case to Congress that the structure of the Fed is unconstitutional. And they were standing on the backs of a 100-year debate that seems to have been lost. And sitting in the front row was William Greider, who wrote Secrets of the Temple, which is an unmasking of the Fed that everyone should read. He was the national political editor of the Washington Post. This was at the mainstream of political debate at that time, right as we jumped off the cliff of neoliberalism in the last great Senate before it was morning in America with Reagan. And my question really is, how do we recover that debate that was in the mainstream of our politics about the governance of the Fed? And the very last thing I'll say is, don't we have a legitimacy crisis with an undemocratic Fed because we couldn't even get an audit of the Fed? And we had to have Mike Lee, Senator Republican of Utah, and Bernie Sanders shut down the government or threaten to do so to get them to show that they gave $21 trillion, half of which went to European banks, and they were hiding it from the American people. How can you have a democratic government when an unelected group that's privately owned is giving away 21 trillion in GDP and then not letting you know, and then dismissing a federal suit, and then defying Congress when Congress has oversight? It seems to be totally broken.
I tried to
Great.
give it to you one at a time, Leah.
Great. No, 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 no. This is fantastic. And they are related. And these are great questions. And this is what I was hoping for because as Stephen mentioned, in the talk, I sort of wanted to focus in on central bank independence and maybe sort of give some explanation, give some tools of thinking about ways to poke holes in the common argument. Because usually when you want to have this discussion with someone from the establishment, it's sort of like, well, time inconsistency, etc. But there's so much more to be said about the Fed, as Patrick has mentioned. So I will say some of it. It's absolutely the case that there is a systemic, empirically proven bias of the way that we conduct monetary policy today in support of the private financial industry, and therefore, as a result, given how that's constructed in our society, the rich. Essentially, the reason, I mean, I do talk about it a bit in the book, but the reason it's not the focus of the book is because, in my view, that's just well established science. That's just true. And I wanted to make a democratic theoretical case that sort of I separated from what you might call the politics or the morality of what they're actually doing. Right. So I wanted to say, regardless of what you think the Fed should be doing, right? Regardless of what you think about interest rates, what you think about balance sheet policy, if we're just only talking about its democratic bona fides, right? I don't care if you would like the Fed to be printing money to build a wall on the border with Mexico, or if you want the Fed to be printing money to address climate change, or you don't want the Fed to be printing money, to address any political matters. Keep your politics to yourself. If you believe in democracy, you have to take my argument seriously. That's how I wanted to construct the book. So that's why I sort of stood away from those things. But you're absolutely right. And the place that it does come out, I think the clearest to me in my research and a bit in the book is in the history of the Federal Reserve. Right. So, one of my favorite stories that I often tell is when the Fed was being set up in the debate on the Senate floor, there was a senator. I can't remember if it was from Iowa or Montana, but a sort of Midwest or Western senator stood up and said, look, I don't begrudge the financial industry a bank to support them. That's fine. But shouldn't farmers have one too? Right. So it was already obvious at the time that this was an institution that was designed to support the private financial industry. And it was given immense public powers to do that. Right. And, some people will argue, yes, but that's because in doing so, that makes life better for everyone. I mean, that's obviously, in my view, untrue. But even if you believe that, you have to admit the first step, which is that this is a public institution designed to support the private financial industry. And the other historical point that really bears that out is if you follow the history of the Federal Reserve, there's been a real clear internal struggle between those who think that the Federal Reserve is primarily a public institution, a US domestic public institution, meant ultimately to serve the interest of the democratic people in the United States. Or is it an institution that was designed explicitly to support the private financial industry, which has now become a global private financial industry? And that's when you see things like bailing out for the foreign banks and that kind of thing. And there's all throughout the history of the Fed, around the world wars, around the development of the BIS, around all of these things, there's a real push and pull internally about what really is the point of the Fed. And I would argue that the latter group has more or less dominated. So yes to all of that. I mean, the mandate I think is quite an interesting thing to discuss in and of itself. I don't want to go on for too long, but in a sense, it's a dual mandate. Actually, technically, it's a tripartite mandate, right? So it's price stability, maximum sustainable employment, and moderate long-term interest rates, right? And actually, it's also told to pursue those three things through the control and adjustment of credit aggregate. So it's explicitly given a credit sort of tool. And everyone always ignores the third mandate, the third part of the mandate, because it's assumed to be redundant. But then also, if you read the transcripts of the Federal Reserve, most governors of the Fed, not all, but many, will argue that the second is redundant theoretically, right? That if you preserve, and even Jerome Powell, in the recent inflationary times, he'll say price stability is fundamental. Unemployment will come if we achieve, high employment will come if we achieve price stability. So it's always been that way, and I think that's an issue, personally. Um, to your second point, I'll just say something quickly so I can get to other people. But yeah, fascinating that you got to be there for that. That must have been a really interesting thing to witness. The Secrets of the Temple, also, I second that. Fantastic book to read. I mean, part of my argument, really, to sum it up, is that we have to get past this commitment to central bank independence and get those conversations happening in Congress again, force them to happen on a regular basis, so that both the legislature but also citizens start to have the feeling that monetary policy could be different and things could look different. And, that could be in all different sorts of ways. That could be about credit policy. It could also be about, restructuring the Fed. One thing I think is, why do we have 12 Federal Reserve banks that are all privately owned and run by bankers? Couldn't we instead turn all of those banks, which have a huge amount of local knowledge about the economy, into regional development banks? There's all these different things you could do that we should be discussing. But thank you for the question. It was a great one.
I'll mention that in the open session, Leah in her book talks about the legislative role versus administrators, and she won't have maybe full time to go into it. I've cheated. I've read the book pretty much. Leah's helped guide me on it. I'm going to try to go into that, and we can write down questions after today's session and maybe feed them to Leah then too. I'm picking on Joff because from the UK, someone nearby Leah right now, except he's in Sweden, I believe, right now.
I'm in France, actually.
Oh, okay. But go ahead, Joff.
Anyway, thank you so much, Lee. Excellent presentation, very cogent book. Much appreciated in the profession. I think you might add a reason against central bank independence is sheer incompetence with huge negative public impact. So, I mean, I'm much more aware, of course, of the UK situation, where the Bank of England and QE bought £875 billion worth of its own government's debt, but did it by buying, as you know, long-term fixed interest bonds, and funded that by creating reserves at the commercial bank on which it agreed to pay full variable interest rates. Then it sticks up the interest rates to counter inflation, so it thinks, and ends up losing 3% on 875 billion. And because there is a treasury indemnity in UK, all charged to the public purse. And as you also well know, because the interest rate went up, reduced the value of the bonds it had bought. If it sells those bonds, it also creates a huge loss. So, this the incompetence alongside a huge public impact. You mean huge public impact? We're talking 100 billion of loss or more. Is, I think, a very strong, which you do make in your book, but I probably suggest that it might be made more strongly. That's all. Complexity, I slightly disagree, because I do think some of the issues are complex. I mean, in my attempt to persuade many of my very intelligent colleagues what's happening under the radar, they say, oh, I can't understand that. And I say, of course you can. This isn't rocket science. But actually, they do seem to find it quite difficult to get hold of. So I think there is a complexity issue, which shouldn't stop us questioning central bank independence, but I think that we should recognize in whatever solution we suggest. But the other problems are those of vested interests, because currently the commercial banks, as you say, have the writ to create money and gain all the seigniorage on it, as well as all the interest on it when they loan it. So they have huge vested interests and have every incentive to try to keep this debate crushed, as do the stockbrokers, who are the only ones in the UK who are allowed to go into the DMO's auction of public debt in the first place, and then make a huge killing selling this to the Bank of England subsequently. There's no risk, and there's been about a £4 billion gain to them. So the vested interests are strong, supported by, and it's linked to it, a bank secrecy. So the huge problem to me, and of course I agree with all that you've said, I want to get it in the public domain, but it's getting it in the public domain to the extent that the central banks are prepared, or almost have to, answer in public debate. And currently, a senior officer at the Bank of England, who's kindly vetted my book to make sure that I've got the detail right, I've asked him, will you not endorse, or can I quote? No way, you can't quote me. Why not? Because we fear it spooks the market. So I gave an internal presentation to the Bank of England about 3 years ago. And at the end of it, they said to me, Jeff, we agree with everything you've just said, but we can't say so publicly because we're frightened of spooking the market. So, we're in a trap, and we need to find a stepwise process out of the trap to achieve the result that you are talking about. But I still do think that complexity is something that we've got to try to address and get the message across in as publicly understandable a way as we can.
No, that I think those are really great points. I mean, just on the complexity point, I'm not trying to say it's not complex. Of course it's complex, right? My point is that I don't see it as uniquely complex compared to all the other areas of policy that a government has to deal with regularly. And specifically, I think that complexity means we need experts to engage, but they don't have to do it on their own, right? So like we can still have the legislature having these, regularly robust discussions. I mean, if you read Andrew Bailey's responses to the House, the committee that convenes, they're insane. They just are totally dismissive. He acts as if he has no responsibility for explaining. I mean, the letter he wrote on paying interest on reserves and the suggestion at tiered reserves was, I think, quite just like rude. It was so dismissive. And so I think that's a real issue. But I don't think complexity drives a need for insulation, right? It drives a need for expertise, but not insulation. So that's kind of the point I'm making. But I mean, your point about sheer incompetence is a good one. I mean, I don't make this very much in the book, but something I've been thinking about recently and writing a little bit about elsewhere is how I actually think that you could make it the argument that central bank independence has hampered the economics profession and the economic bodies of knowledge, because essentially we've taken out the possibility of failure for central bankers, right? They're sort of, they just do what they want, they try something and they move on and try something else, and there's no real challenge, right? Look what happened in 2008, and people kind of got angry, but nobody went to prison, nobody lost their job, really, and so I think that has also hampers the development of good economic knowledge, right? Because we don't have the failures that we need. And I think that is a real issue. I mean, get into the UK. I mean, I think the indemnity is just outrageous. And even more outrageous is they won't print it. We don't even know the terms. The public doesn't. That to me is absurd. And it's a real issue. And then just to mention that sort of to connect that, because a lot of the accounting issues in the UK, they accuse I mean, this is one case in which I think the US is doing better than the UK in terms of like delayed losses. There's nothing wrong with that. I mean, the accounting principles are all made up anyways. And I think the UK has hamstrung itself really in that case. And then lastly, just the vested interest point is I talk a lot in the book about this, and I don't think it's something that people talk about enough, is the fact that since 2008, 2009, sort of depending on your jurisdiction, most central banks started conducting monetary policy by paying interest on bank reserves. And that to me is absurd. Not just especially for the political reasons, right? So in the recent inflationary context, the Bank of England and the US and the Federal Reserve were paying out billions to private banks in a moment where people were suffering the most. You don't have to conduct monetary policy that way. And it's a ridiculous thing, and it creates even more vested interest, as to your point, because the banks obviously are getting huge chunks of money from the state that they don't have to do anything for. So I think looking into the details of how this all works just bolsters the idea that this is far from a democratic arrangement. And I think, in my view, we need to bring it into the public. And I think I don't blame the people at the Bank of England for not wanting to put their own name on it, because in my view, and this comes out more in the book, it's really failures of the legislature. The legislature doesn't want responsibility for this because they don't want to be held accountable for it, but it's their responsibility. They need to be taking more control and figuring out what's going on, you know, and making it public and having a discussion about how it could be different. And that's kind of the why the proposals are trying to force the legislature to engage. But how do we actually do that? Well, I don't know. I mean, in the UK, unfortunately, the only party that's taking these things seriously right now is Reform, and they're not going to do it in a way that probably I would support.
Very
Um, but
problematic.
they but they are arguing about it, and they're bringing it into the public debate, and we need more parties to be doing that, in my view.
Agreed.
Mike Holden, is there a question from the chat?
Yes, there are some questions in the chat, but Sue Peters, who had the questions, has her hand raised. So if you'd like to go right to Sue, you can go right to Sue.
Sue, go ahead then. Thank you.
Oh, hi. Thank you so much. This is really wonderful. Just two questions. Are you familiar with John Titus's videos where he specifically agrees with you about central bank independence? You can find him on YouTube under the playlist Best Evidence, 2 words. I highly recommend him. And the
Okay, thanks.
Yeah, and the second question is
that from the chat?
What?
Go ahead, Sue.
Okay, the second question, Leah, is since the beginning of the Fed, in that organization, they have had the power in their commercial banks and within their own Federal Reserve banks to create the elastic currency, right? So bank credit, right? And that power has, from the beginning, had a very controlling piece over our Congress. In fact, as you know, the history, it influenced the passage of the Federal Reserve itself. And how do you stop that power from keeping our legislature from changing the Fed, specifically because, one, with that power, the citizens of the country are kept unable to control their legislatures. The citizens are so pushed down by the economy that they don't have the wherewithal to even have the time to get involved at that level. So that's my questions, 2 of them.
Thank you, Sue. The
Yeah.
second question's a good one.
Yeah, no, it's a very good question. I think there's sort of 2 things I would say to that, but both in recognition of the fact that we're in a real pickle of how to actually get to figure out how to sort of make the change that we need to make. The first thing is to say that, which Stephen was mentioning, in the book, there's quite a lot of work on the administrative state in general, which central banks are obviously a part of, and how it relates to a kind of democratic structure more broadly. And so I talk about how we think in democratic theory of sort of political power traveling along a chain, sort of from citizens to elected officials, and then from elected officials to administrators, and in some cases, like in monetary policy, from administrators on to sort of private sector for sort of policy execution, and how key to sustaining a healthy democracy is sustaining the tightness of that chain. And the focus of the book is really the link in the chain from the legislature to the administrative state. And that is not at all to downplay the essential importance of the link from citizens to the legislature. And I think that's a link in the US that is particularly corroded at the moment for the obvious reasons that we all know, but we don't talk about because they're so obvious, but we don't know what to do about them, right? Gerrymandering, campaign finance law are the 2 big ones. I don't know. I'm forgetting the exact number right now, but the statistic of how many members of the House of Representatives, after they've passed their primary, actually face a serious contest to be reelected is absurd. It's like under 30 out of, hundreds of members. So that's a real problem. And that is a real issue to the health of a democracy over time. The reason I don't focus on that in the book is because, similar to my answer, to Patrick at the beginning, is that's very well established in political science. Everybody knows it. It's a huge problem. Your question is sort of, how do we then go about changing that? And in addition, when we're under a system of monetary policy that so strongly favors the private financial industry, and in the US, that feeds into political power, you're in real trouble. I mean, my view is, you could say it's slightly naive. You could say it's sort of democratic. But my view is essentially that over the history of all sort of human political thought, the answer of gaining power to the masses, to the many, or to the poor, which for many years in political thought were considered synonymous, is through political reform, and in particular through monetary reform or land reform. And I think that's what we have to do, and that's what we have to focus on. And I think we have to, focus on electing the right people and pushing them to focus on the right topics. And that, in my view, is money and monetary policy. And that's why I wrote the book. So, my answer to you is perhaps somewhat disappointing because it's somewhat obvious, but that's the only way I can see going forward. And the part of what the book is essentially is to try and, should we get someone who's ready to do stuff to make it better? Here are some suggestions for how we can maintain that power over time, how we first achieve that power to actually institute the necessary reforms. That's the hard slog of politics. And I am happy to say I'm not a politician, but we need some that do it better than the ones that are doing it at the moment, in my view.
Thank you. And an apology to Eric. I was promising myself we would get to you so we could get to a global conversation, but we have Mirza Bahadaran coming on in 2 minutes, and she's going to get it. Well,
She's amazing. She'll be fantastic. Yeah.
Make sure she's joined us, Stephen. If she's not joined us, okay,
I'm
great.
here.
Oh,
Yes.
great. Thank you so much.
And
she's got a hard stop in 60 minutes. That's why we're trying to start on time.
Yep, we will. We got 2 minutes to go. And just to Leah, a huge thank you. And we're going to try to get you back for part 3 too. So, and maybe more strategy talks.
Yeah, great. Thanks very much for having me. Good luck, Mirza, solving all the monetary problems. Bye, everyone.
Yeah. Leah, stay.
Yeah, thank you.